How do you find stocks that offer good value, but also the kind of growth investors have been chasing? Coming up, we'll hear from a seasoned investor who will identify 6 stocks he thinks offer exactly that. So let's get started. This is Ticker Take.
John, today we're going to try to understand the misunderstood.
That's right, Caroline. Misunderstood stocks that could represent an opportunity for investors.
Exactly. Our guest today, Grant White of Endeavor Wealth Management, believes in long-term growth themes, but he also believes in getting good value.
Exactly. Yeah, he sees himself as an opportunistic value investor with a growth lens.
Which is an approach he thinks could be helpful for investors to follow, especially after the easy money that's been made in this bull market.
Exactly. Yeah, he doesn't want to go chasing overstretched valuations. So let's start by giving you some more perspective on Grant's thinking.
I think the way you describe our investment style is pretty accurate. I mean, I think we're certainly not like deep value investors, and we're not just pure growth investors. We look for value in what I would say is unique places or uncovered places in some cases. We tend to favor smaller businesses, smaller to mid-size, and just because that's where we can find those opportunities more. And I think like we're at a really interesting time actually, because like momentum and so many other factors that have like led the markets over the last couple of years, like especially with the AI trade. I mean, it's really carried things, and that's made it actually somewhat difficult for a lot of investors out there. I mean, because there's no value in trying to find like a value in Microsoft or value in even Alphabet or companies like that today, because everybody knows they're great companies. And so I think what is going to be a challenge going forward is that we're going to see choppiness. We have seen choppiness in the AI trade. I mean, I think you look at companies like Microsoft, I think it's down 10 to 15% from highs. Oracle certainly down more than that. We're actually entering close to bear market territory on some of the companies that have led the markets over the last couple of years. And so I don't think people are really thinking that way, because markets have actually held up quite well. But yeah, we're certainly in correction territory on a lot of them and closing in on bear market. And I think that you're going to have to be a little bit more creative going forward, and especially in 2026, because like the growth story might not be in what it has been in the last couple of years. And I think there's a lot of opportunity out there, but I think you're going to have to dig quite a bit deeper than the headline stories to find it.
All right. With that in mind, Grant is going to walk us through 6 stocks that meet his investing criteria.
Yeah, he sees these as solid businesses with reasonable valuations. Now, what's his rigorous criteria to identify the stocks? Have a listen. So
I think like the common thread between all of the companies that we're looking for is really 2 things. I mean, we do really like good high growth companies. I think like when you look at all the companies that we have on our list or in our portfolio for that matter, they are high growth companies. We're not looking for that like cigar butts or deep value type of companies. We want growth. In particular, we want growth in free cash flow. That is something that is deeply important to us. We still look for companies that we can find at value prices. So you have to go beyond, again, the headline or the typical story that people are familiar with out there to find it. But I would say it's like we're looking at good value from high growth companies. And so we also love multiple revenue streams where we can find them too. So companies that aren't so tied to one thing, one product type, but if they have multiple revenue streams coming in, that almost safeguards them against like being wrong in one area or another. So for those are the common threads you'd see, but good also capital allocators in management is quite common in our portfolio.
Okay, with all that said, let's get to Grant's 6 stocks. But first, a friendly reminder, this is not financial advice. Stock number 1, MercadoLibre.
Yeah, Wall Street loves this online trading giant focused on Latin America. 90% of the street has a buy rating. Let's get Grant's take.
I think this is a really interesting company because, frankly, as North Americans, Canadians, we all know Amazon. We know companies like Amazon out there. And I think what people fail to realize is that the world is kind of carved up for these like e-commerce platform businesses. And there are certain advantages that you can have in parts of the world. Like Amazon isn't the juggernaut that it is in Canada and the US the same way it would be in other parts of the world. And so in particular, Latin America, MercadoLibre is the juggernaut. It is the stalwart there, where it's got all of the infrastructure in place. It's got these moats around it. So you can think about it like Amazon, but for Latin America. But the benefit of that is that one, there has been pricing opportunity. I'd say there is still pricing opportunity, and there's also a lot of growth opportunity for this company. And we expect that we're going to see, revenue growth of about 25 to 30% per year, continuing on over the next 3 to 5 years. I think that's realistically what this company is capable of. They've shown like really strong management and the ability to execute on their plans. And so, we love them from that perspective. It's also a multi-platform business as well, just like Amazon is. So, I mean, it's got e-commerce, but it's also got payment systems. It's got, it's got the logistics business. It's got all of the same stuff that you like about Amazon, like I said, from an e-commerce perspective and a consumer perspective, but it just has a nice moat around it. And so such a nice moat that it's actually hard for an Amazon to compete with them because they can't achieve the same experience, not easily anyway, and not without billions of dollars in investments in Latin America to kind of become the equivalent of MercadoLibre. So for all of those reasons, like I said, if you like Amazon, I think you should really like MercadoLibre because it's kind of like buying Amazon at an earlier stage and at a better price.
Stock number 2, C Limited.
Well, like our first stock, also a well-liked name. About 90% of the street is giving it a thumbs up these days. Again, more from Grant.
So C Limited is actually very similar. Like you can see a common theme here in our portfolio. C Limited is very similar to MercadoLibre. It's based in Singapore. Now, one of the things that's really nice about C is that I think people, especially North American investors, thought it was Chinese, and it's not Chinese. It's based in Singapore. But like when all of the holdings, like Alibaba, for example, were taking a bit of an attack, and people were exiting those positions, C Limited was also seeing that pricing adjustment going on as people were selling out. And I think that was a huge mistake. One, because like over the last couple of years in particular, management has really executed well. They've gotten to profitability. They have a high growth rate. Again, it's in that 20 to 30% range per year, and we expect that can continue on. And overall, I think that you're getting actually a really unique pricing opportunity. So it's a very similar to an Amazon-like platform business or MercadoLibre for that example, for that matter, but it's based in Singapore. So Southeast Asia, hence C, the name, is their region, and they've got a formidable moat in that area as well. And so again, it's a bit of like an early stage Amazon, if you will, but it's in a completely different part of the world, and arguably it's in a faster, higher growth opportunity part of the world than what an Amazon is here in North America. And so, arguably you actually have a much better opportunity from simple population in the vicinity of Southeast Asia. So for all those reasons, again, better pricing, high growth rate, and a really great management team that's executing at a high level. I think C Limited is a great buy, and it could be a great core holding in your portfolio.
Stock number 3, CNX Resources.
Okay, here's a stock where most analysts who cover the company are taking a wait-and-see approach. They have a so-called hold rating. Now, the shares did have a nice run at the end of 2025, but let's hear from Grant on this one.
So CNX is a really, I think, a very interesting company today because, I mean, as Canadians, we love our energy companies. So CNX is not a Canadian company. It's based in Pennsylvania, but we love our Canadian companies, and our energy companies, I should say. And CNX should be somewhat familiar to us from that perspective. But what's unique about them is they're a bit of a midstream natural gas exploration and production company. They have a unique positioning because of where they are in the world. They are in that shale area primarily, which they've got that like nice pricing opportunity because of it. They also have an excellent management team that has, I think, posted 23 consecutive quarters of free cash flow growth, and so they've done so well through different pricing opportunities in natural gas that they've shown that they can execute at a high level no matter what the pricing seems to be doing, essentially. They're uniquely positioned, as I said, in their space, but they're also like they have upstream and downstream pricing opportunities because they control the pipeline in the middle. And so for all of those reasons, actually, no matter what natural gas prices are doing, we feel very confident in their ability to produce positive free cash flow and growth for us in a share price. The other thing they're great at is, as I mentioned earlier on, is we love good capital allocators. They are buying back shares on a consistent basis and frankly at a pretty high level. I mean, I think in the last year, they've bought back shares to the yield of about 20%, which is frankly incredible. So they're actually, even in a flat environment, they're actually able to add earnings per share simply by like buying back more shares. And so for all of those reasons, good management, good opportunity. I mean, never mind like the fact that hey, if AI proves out to be the story that we all think it is right now with energy demand and so on, they're going to be at the forefront of that. The only thing I think working against them is possibly sentiment on natural gas, because they're really like, again, great pricing right now. But if sentiment turns more positive on natural gas, then this company is going to do extremely well, and from a share price perspective.
Stock number 4, Cipher Pharmaceuticals.
Not to be confused with Cipher Mining. This is not a stock that's covered by a lot of analysts, but the ones who do are quite bullish. Here's Grant.
Okay, so Cipher is a really interesting, actually Canadian pharmaceutical story here, but it's not your typical pharmaceutical story, because what they're really good at is, again, that capital allocation side of things. They're not getting, I mean, they're not focusing on R&D like the major pharmaceutical companies are. So they're not spending big bucks on that. They're also not necessarily spending big bucks on distribution either, like a lot of pharmaceutical companies are. What they're really good at is essentially licensing and buying up drugs that are in like less common spaces. So, their bread and butter is areas like skincare, like acne, things like that. So lesser known type of drug opportunities as compared to like the majors out of there, whether it's the Pfizers or you name it. So they're playing a very niche space. And because of that, they're actually able to carve out a part of the market that they can be highly profitable at, while still managing, because they're managing their costs so effectively, I should say, on the other side. Another area that they've been really good at is frankly licensing, where they basically buy up the licensing on a drug, but then they're actually licensing that out to other companies for distribution. So they're really just taking the margins out of it in that respect. So again, I think that this is more of a story on the fact that they've been really smart asset allocators, really smart management team there, and they've carved out a niche part of the market. Because of that, I mean, they could be, I mean, we don't necessarily need them to be an acquisition target. They could be an acquisition target, but actually more importantly, I think that like it's more predictable going forward because their management's been so strong, and that is likely to continue for some time.
Stock number 5, Thryv Holdings.
Like Cipher, not a stock that has a lot of coverage from analysts, but of that small group, when you look at their belief on where the stock could be going, most of them are pretty positive. Let's get Grant's take.
So Thryv is, I think, a really interesting company because it comes out of like legacy business, like Yellow Pages in particular. That's where Thryv, it actually was formed through the merger of Yellow Pages, and there was another company in there that was more on that legacy side of things as well, like of like old like listings basically. And so out of that, when that business was dying down, like Yellow Pages in particular, they formed Thryv as kind of the next phase of like, counteracting that. And so what it is, I mean, it's a SaaS company. What they've essentially done is, you could think about it a lot like Shopify meets Salesforce. And because what they've done is they've developed like software to help small businesses to not only like promote their own businesses, but also create efficiencies within the business themselves. Why they're really unique though, and why they're not showing up on like a Salesforce type of radar, is because they've really carved out the niche for some mid-cap size businesses, but really it's the small businesses where they really thrive, no pun intended, because that's an area of the market that was underserved. For the companies that can't afford like a Salesforce type solution, that's where Thryv solutions come into play. And so they're really beneficial in that space. So they took their existing client base, basically from the Yellow Pages days, converted them over to SaaS clients and put them on subscription models. And so they have a really nice business model there too, as well, because they have that consistent cash flow coming in that they've been growing at about 10 to 15% per year. So it's not the high growth story, but it has been consistent, and they've really carved out a nice part of the market that frankly there's not a lot of competition in, and so for all those reasons we really liked this company. Because of it's also the fact that it kind of flies under the radar, there has been pricing opportunities there, and so I think that you're getting a decent growth story, but you're getting a good pricing opportunity as well. The other side of this is it is a potential acquisition target. Again, we're not banking on that per se, but because of the nature of their business, you could easily see this getting scooped up by another SaaS company at some point down the road, because it's carved out that niche target. So if for example, if a Salesforce or a company like that wanted to get into this side of the market because they have no space in it right now or no stake in it right now, Thryv would be a top acquisition target for a company like that.
And stock number 6, Block.
Yeah, Block is a well-liked stock on Wall Street. Almost 2/3 of the analysts who cover it are recommending it these days. Just as interesting, on average, they would not be surprised to see a double-digit percentage gain in the stock over the next 12 months. Let's hear from Grant again.
Yeah, so Block is probably one of my favorite companies actually right now. It's been a frustrating company from a share price perspective in a lot of ways, but the business itself is I think it's quite ingenious. Once again, Block, and so this is for people that don't know, Jack Dorsey is the founder of Block, so former Twitter fame and now Block. They created this company that, again, was carving out a piece of the marketplace that was really underserved by credit card companies and much larger e-commerce businesses. And typically it's that small business area where they've actually created some very unique solutions, not just for the retailers or the businesses themselves, but actually they're playing both sides, and they've become a very consumer strong business as well, which I really like. So their product is Square. So anybody, like a lot of people would be familiar with that, especially if you're going to small businesses or markets. You're going to see Square, like their product line on iPads and stuff like that when you're doing the purchases. What people don't realize all the time is that they have the consumer product called their Cash App, which is their peer-to-peer service. And they've also gotten into crypto as well as a crypto wallet. So a lot of Bitcoin trading is going on through their Cash App as well. So that's where they're playing both sides of this. So I like companies with multiple revenue streams and sources of revenue streams. That's exactly what Block has done in the last few years. And they've just barely scraped the surface of realizing the benefit of playing that more consumer-driven side of things, including things like, deferred payments on certain products and stuff like that. They did an acquisition last year of a company that has brought that into the fold as well. So for all of those reasons, I think Block is a very interesting company. I think they've carved out a very unique part of the business. They've in fact even competed against Amazon. At one point, Amazon tried to emulate their Square product line, and it didn't work. Actually, Block beat them out, and it was because, frankly, Block had a better product, and they also realized that design does still matter in some of these things as well. And so they're capable of navigating this marketplace, this economy very well. I think they're very well positioned. AI is actually a huge benefactor to them because it adds in more efficiencies into their business, reducing costs while opening up new opportunities. High growth rate, 15 to 20-ish% per year in terms of revenue growth. And for all of those reasons, I think that Block is actually super well positioned from this point going forward. I think they're going to have a really good 2026.
All right, our thanks to Grant, and our thanks for watching here on the BNN Bloomberg YouTube channel. TickerTake has its own YouTube channel. There's a link in our description if you want to check it out.
See you next time.